Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the couple of disclaimers that I need to show you, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or long-term themes, short-term themes that decrease or increase in importance over time. So yes, our goal is to break down all the market jargon and complexities that we all read about and you read about. So if you do have any questions, please do ask them along the way, and we'll try and answer those as we go, or at least at the end of the webinar. Okay, it's Wednesday, it's March the 5th, just after 11 a.m. London time. And firstly, we'll just look at a couple of the major themes. Of course, there are multiple drivers at the moment in markets, and there is a lot to get through, really, to understand. Just a fascinating time, it really is, in markets and generally across the sort of geopolitical space, the global geopolitical space at the moment, of course. We'll just look at tariffs, we'll look at Europe, and we'll look at the sort of fading of US exceptionalism and the Trump trade over the last few weeks. We'll look at Tesla and Bitcoin, actually, which are really sort of fine examples of what's been happening with those two themes that I've just mentioned, US exceptionalism and Trump trade being faded, of course. We'll just check out those on the charts as well before then really having a look at what's ahead of us this week, really. So we have the ECB meeting, so we'll look at euro dollar, and then we have non-farm payrolls, of course, so we'll look at the dollar index and just preview those in amongst everything else that is happening at the moment. First up, actually, and if we have time as well, we'll look at Nvidia's results and just check out that chart as well. So lots to get through, and we'll just try and make sense of it first up. If I just show you first of all a couple of charts, which I'll just grab here, so just bear with me 1 second. In fact, we've got the oil chart first up, just of interest because we're at a key level of support, actually, that you can see here, around 70 bucks in Brent crude. You can see this is the weekly chart, actually. So we go back to 2023 in the low from March, around 70, then strong support here through last year, 2024. So major support around this level, and we're just breaking through that sort of level around there now. So really interesting point for crude. Kind of sums up markets in general, and how much politics really is playing such a big impact in markets, as I say, in general, especially equities. And we'll just get to a couple of charts, obviously, as well. We'll look at US equities, which we've had the big sell-off, of course, recently, and you contrast that with European stocks, which are absolutely flying. And the DAX really up sort of 13% or so on the year, whereas the S&P is actually negative on the year now, and down pretty much flat to down compared to just before the November US election. You can just see, before I get into some fundamentals, you can just see this long-term bull channel, series of higher highs, higher lows, and depending on where you break, draw the lower part of that channel, then we've just broken out of it, that you can see, and we're touching now the 200-day moving average on the S&P 500. Really interesting point for equities. As I say, politics really at the forefront of everything, really, and kind of really needing a sort of assessment of the most likely outcomes and the associated risks, really, and opportunities. To add perspective in a way, it's kind of essential to note that it kind of is a unique situation at the moment. It's not really classic macro-driven sell-off that we're seeing, and really we just have to look at some of the moves yesterday. So in Europe, we saw equities move higher, consumer staples especially higher, despite the broader indices drop actually yesterday in some of the European indices, although they're up today. kind of indicates that investors really not overly nervous actually about stocks really, and instead it's this rotation that we're seeing between geographical areas, between sectors, as well as much as selling equities. And yesterday, prime examples of bond yields, they remained pretty stable in Europe, at least until today's massive move higher in Bunds, which is the German government bond. But then we did see the long end rising in the US. There was no safe haven flow to the dollar, and then oil, as I've just showed you, has been falling. And then Bitcoin even gained yesterday, although there's been strong volatility in that. As I say, all kind of just suggest investors are undecided really about the direction, being pulled and pushed in different directions for the global economy, and that creates basically upside and downside risks. Of course, then bottom line with tariffs, certainly, I think this is interesting. We've had that with comments overnight from Lutnick, basically saying that Mexico and Canada have promised to do better, and that suggests potentially that Trump could announce some tariff relief in the next few days even. If we just think about tariffs briefly, well, economists reckon the measures that have been imposed, 25% tariffs on Canada and Mexico, could increase the effective trade-weighted tariff rate on all US imports close to 11%. That would be the highest level since World War II. It would then lop off around 0.3% of US GDP. And even though Trump says foreigners will pay due to the stronger dollar, kind of nullifying the impact on US prices, virtually every economist that you read about says that US consumers will take the brunt of price increases. That is what tariffs mean, really, and really then you kind of figure that we will see some sort of relief at some point. One caveat to that I should mention is generally the fact that if Trump sees tariffs as raising revenue and then potentially paying for tax cuts further out, which we haven't seen or mentioned yet at all, but if that is the goal, then possibly tariffs are seen as a longer term deal and will not be reversed anytime soon. So that's just the tariff sort of situation at the moment. Very flexible, very fluid, and a lot of headlines to play around with if you're a short-term trader. That is the S&P as well. If you look at the NASDAQ, similar sort of situation, a sell-off, but now we've had a strong move higher in futures. If I just show you futures, we're now, the black line is the 200-day moving average. So there is, we tapped that, but have held above it. On the cash side, you can just see the close above it as well. Really interesting price action. And you can see that black line really as very strong support in the last year or so, where we've tapped that in October 23 and then bounced, tapped that in August 24 and bounced. So really interesting sort of level of support, and it always gets a lot of the media talking about the 200-day moving average as the sort of key long-term moving average that everybody looks at. So yeah, we've just bounced off that in the NASDAQ. We touched it on the S&P virtually, and we've bounced even though we closed lower. And if I just show you the futures, then again, sort of getting back potentially as we open half of what we lost yesterday. So really interesting moves. The Dow, well, here's the Dow. We're not anywhere near that 100-day moving average, but you can just see how we moved down below the 100-day and 50-day. But then futures, you can just see clawing some of that back as we move towards today's open. Just on Europe, I just wanted to mention, of course, you know, massively in the headlines at the moment with this fiscal bazooka, I think is best explained. What can you say? Well, critics always say that European leaders only react in a crisis, and certainly then this prospect of the US withdrawing its security umbrella from Europe is now deemed a crisis for sure. We've had two significant events yesterday only, with the European Commission basically triggering national escape clauses from the Stability and Growth Pact that could unlock 650 billion euros of national spending and other measures, actually totaling around 800 billion euros. And then, of course, we had German leaders basically agreeing a suspension on the debt brake and potentially then unleashing 500 billion euros plus for an infrastructure fund, and a similar amount, I think, for defense spending as well. So that's what we've had on the European side. You've had European government bonds just going through the roof as they expect, obviously, additional funding for this these new funds, essentially. And you've had euro dollar going north above, well, close to 107 now, and we'll look at euro dollar shortly when we look at the ECB. And then you've had European stock markets as well, reversing a lot of those gains. And I've just shown you here the DAX. So this is a main German index, and you can just see, I'm just checking that you can just double check that you're looking at this, that you are. You can just see again, really strong bull channel, broke down yesterday, down over 3.5%, I think the index was, but then this big bounce today, up over 3% again. We're challenging now those record highs just above 23,300. So we dipped out of that channel, but then very quickly bounced back, and we're still in the channel, which I should really draw again. Yes, there, and we're back in it and challenging, as I say, 23,300 and above in the DAX. For Eurostoxx, again, similar sort of move where we, this is Eurostoxx 50. So yes, back in the sort of range trade and challenging potentially that record high at 55.68. So yeah, a lot going on, as I said. Otherwise, there's this fading of US exceptionalism, the Trump trade. That was hit by sagging US data, including consumer confidence, and then some of the personal spending data last Friday, and especially growth stocks have been hit hard too, really. Questions around stretched valuations, an overspend on infrastructure plans to chase this AI boom, and then obviously cheaper asset prices elsewhere. And that's where you've seen again this rotation with big tech underperforming, and then other areas of the market, European stocks, value stocks in the US also holding up versus yeah, big tech and even some of the Russell as well underperforming massively. Two instruments that do show up this very well, Tesla and Bitcoin, as I said. And if I just pull up, first of all, Tesla, just an example of this Trump trade fading. It's down now around 44%, I think, from its record closing high at $480. That sheds near $600 billion in market value off Tesla. It's down 35% or around that since Trump's inauguration on January 20th. And then down, well, it was down around 16% last week alone. That said, it's still up, I think, over 20% since the October 10 robo-taxi day for Tesla, when they basically talked up plans for a self-driving taxi this year. I'll wait to see, we'll wait to see whether that actually comes to fruition. But certainly Tesla, yeah, facing mounting challenges, declining sales. We saw that in Europe, down 47%, I think, in January. Growing competition, of course, and then just general sort of brand perception issues due to Elon Musk, of course, taking a more active role, really a more active political role in the Trump administration. So really interesting level here now for Tesla. You can see the black line again, 200-day moving average of 279.80. Then we've got these long-term levels from the swing high in July of last year, also October last year, around sort of 268, and then we've got a fib level of this move higher from those lows in April 24 up to the record high, and we've got the 61.8 around 272 as well. So strong sort of zone of support here, really, the 200-day moving average at 279.80, but then those levels just below that as well. So you can just see we printed a doji candle, really denoting indecision really around this level, and we're just, well, we're still sort of sitting on those swing lows and that fib level around 272. So Whether this 200-day acts as resistance or support, we shall see. If we do lose this support, though, then yeah, it doesn't look good, and potentially a move lower will take place. As for Bitcoin, just to show you that as well, again for this fading, really interesting. We saw that sharp sell-off last week, actually, where we dipped below 80,000, and then we had that Trump announcement over the weekend, basically saying that yeah, Trump would include Bitcoin, Ether, XRP, Solana, and Cardano in some sort of US strategic crypto reserve. That saw a big bounce, around 10% on, well, Sunday night, actually. Before then, a big, again, a reversal of that move pretty much on Monday. And then we've been oscillating around that again, the 200-day moving average really proving important. That's around 82,739 at the moment. And we're just bouncing off that we did yesterday, and potentially now you can just see up 3%. Very volatile price action in Bitcoin. There is meant to be a Friday White House crypto summit, so that will be interesting and probably a key event really for market sentiment at the moment in crypto generally. February, just to reiterate, was Bitcoin's worst month since mid 2022. Dropped 17% in February, I think, all done. So yeah, just another example of the sort of Trump trade fade, if you like, and a lot of volatility around that. Okay, let's move on now to first of all, we'll look at, well, non-farm payrolls actually. And if I just show you a couple of charts, first of all, firstly, yeah, we'll look at non-farm payrolls. Big week for US data, top tier data actually this week as well, just to add to the mix of everything else. We've had already US ISM data out yesterday, Monday, sorry, that was, which was interesting. The ISM manufacturing, that declined actually from 50.9 to 50.3 in February. Consensus was 50.7. That suggests the rebound in production really stalled in February. Different to the PMI figures as well, which were revised slightly higher actually. So looking ahead, the risk related to tariffs on key trading partners could add to the ongoing rise in input prices as well, which could then add to goods inflation depending on pricing power across producers. That was Friday. Then Wednesday, today, we do get ISM services data. That's non-manufacturing ISM data. That's seen rising to 53.0 from 52.8. Services activity, of course, has remained in expansionary territory since July 24. But just note, other business surveys do point to downside risks, with again a focus on inflationary pressures. For non-farm, then, that comes out Friday. We get a couple of figures before that. ADP, not really an indicator, let's be honest, to non-farm itself actually, but we get that. And then non-farm on Friday. Here's a graphic with all the main numbers that you can see. Markets really, well, headline at the moment I think is around 133k expected. That would be the lowest since October and down from the prior weather-related 143k. Watch out for revisions, of course. Just to note, the average pace since the start of 2024 is for 165k, and the 3-month average actually much higher at 237k. So that's the headline. Unemployment, that's predicted to remain steady at 4%. That's an 8-month low. And just remember, the Fed's December projection for unemployment by the end of 25 is 4.3%. Wage growth, that's seen coming lower actually from the 0.5% previously to 0.3. Generally a sort of longer term number around 0.3. Remember, 0.5 actually was the highest rate in around a year. So just some cooling off from that. Job cuts initiated by Doge, they'll actually take a few months to probably feed into data, although government payrolls figure will grab some attention of course. Other job indicators, just for a guide, they point to a soft report with PMI employment figures recently falling below 50 for the first time in 3 months. I've just got in here when we expect the next, or markets expect the next, or the next 25 basis point rate cut from the Fed. That has moved around, of course, with all this movement in treasuries and markets generally over the last few days even. Now brought forward to June, actually, the first rate cut around 79% or so. That was higher yesterday, I think, but was much lower even only a few days ago. Means around, I think, 66 basis points of cuts for 2025. That is up substantially from just over 125 basis point cut even just a few weeks ago. That's moving around all the time at the moment, but yes, high chance of a June cut at the moment going into these figures, but of course, as I say, will change depending on obviously a lot of the geopolitical and tariff news as well. If we just look at, there's just a guide for you. Just 133 was the sort of Reuters poll, just coming down from those figures from the last few months. If we just pause it there, and we'll just have a look at the DXY chart as well, which I'll just show you here. So you can just see, obviously, we've had this big sell-off in the last few days. We're tapping the black line again, the 200-day moving average. Very important on a few markets now, so really crucial point, whether we find support here. You can see that's the halfway point of the September rally. That's a 105.16 as well, so should be fairly decent support here. If we do lose that, then really we want to show you the 61.8 of this retrace level, which would be at 103.98. So that would probably be the next target for bears in the dollar index. Remember that this is an index of the dollar's 6 main trading partners, and by far the biggest weighting in this index, the euro with about 57% weighting. Next up is then the sterling and yen, around 12-13% for both of those currencies. So they make up the chunk of the index, with euro by far the biggest. And obviously with euro getting very strong this week, then that is why we've seen this sharp sell-off in the dollar index in general. So that's non-farm payroll to look forward to on Friday. Just before that, of course, we have Thursday's ECB meeting. If I just show you, first of all, just a little chart with where we are compared to previous rate cutting cycles. So you can see back in just after the turn of the century, really, 0103, we had 7 cuts totaling 275 basis points. Then after the GFC, we have 5 cuts totaling 300 basis points. Then Eurozone debt crisis, we had a short 3 cuts sort of rate cutting cycle, 25 basis points each there. And now, of course, we've had 5 cuts totaling 125 basis points. Markets fully expect another 25 basis point cut. That would be then 6 cuts of 150 basis points in total. That takes the depot rate down to 2.5%. And really interesting now, we're getting to sort of the upper part of the neutral rate, if you like. And really there's all big question marks about then whether the restrictive language that the ECB talks about, whether they take that away from the statement, or whether we're still in restrictive territory or not. Markets fully expect a 25 basis point rate cut. Policymakers fairly confident inflation will turn to target over 2025, even though January inflation figures actually ticked higher to 2.5% for the headline, while the core remained at 2.7%. Growth concerns, of course, they still linger, especially with likely upcoming tariffs. The Q4 GDP revision, that saw it print at 0.1% versus 0.4% in Q3. And the most recent PMI data, that came in at 50.2, so just about in an expansionary territory after manufacturing ticked up and services ticked down. We do get staff economic projections. They're out every quarter. and I think consensus sees lower growth, but then higher near-term inflation forecasts. And the hawks, of course, have been quite vocal recently, really asking how much or if any more policy easing is actually needed going forward. So, yeah, there, you would think will be now intense discussion about where the terminal rate is, and especially, as I say, now we're up the sort of at the sort of upper bound of the terminal rate in general. That's seen at sort of 2.5%. Then there should be really, yeah, as I say, quite intense debate going on in the governing council between the hawks and the doves as to where or how many more rate cuts there may be. As I say, it will be, if you're looking at this in detail, about the language used and whether there are tweaks really to the restrictiveness that is used. If we do get no longer restrictive in there in the statement, or sort of pushed by President Lagarde in the press conference, then that could potentially set the stage for a pause at one of the next ECB meetings. Markets, they price in around, I think it was around a 2 in 3 chance, 65% chance or so of another cut in April, with the next one though fully not priced in until June actually, and there was a total of around 80 basis points or so by year end. Interesting that in amongst all the movement on government bonds, of course, in Germany, of course, we haven't had that much change in ECB pricing, which says various things to you. But for us, then, really interesting that, if you bear with me, because I'll pull up a chart, but if you just think, yes, there hasn't been much change in pricing in ECB pricing, sorry, versus obviously what we've seen in Eurodollar, which has obviously jumped higher. And normally you would think the combination of basically this looser fiscal stance and then tighter monetary policy would be currency positive. The issue for Eurodollar is that, well, the fiscal news has not moved, as I say, that needle on ECB policy expectations. Prices still see a low point for the ECB easing cycle near sort of below 2%, actually around 1.75%, as I said, around 75 basis points, 80 basis points still priced in after this rate cut. And that is certainly a function of the global tariff threat, which looks like it will be coming Europe's way potentially next month. I hope that makes sense to you guys. What I want to do now is just show you the Eurodollar chart finally. We said we'd get to it eventually. Really interesting now. Again, the black line is the 200-day moving average. That's at 107.25. Amazing how we're getting to this sort of key long-term moving average on on lots of different charts. So you can just see how we haven't hit that level for so many weeks and months really on a lot of these key charts, and now we're just getting to this point, which is a key pivot point really. Potentially if we do hit that, then we are slightly overbought on Eurodollar. You can see that at 107.25. We've got the halfway point of this move lower at 106.95, which we're now just below. So interesting whether we can break above here or not. As I say, slightly overbought then, and that warns of a correction or at least a pause in this strong bullish momentums that we've seen over the last few days. Obviously, then we have the ECB meeting and then non-farm payroll as well to contend with, all amongst the sort of geopolitical news. So yeah, that's where we are at the moment. One other probably good point to look at, we think, is as well dollar CAD, because that has of course taken the brunt of tariff sort of volatility as well. Just cast your minds back to obviously the start of February when we had the announcement of the 25% tariffs on Mexico and Canada. Then that was reversed intraday, so you can see that spike higher to 147.92, multi-year highs. If I just pull it back, you can just see again we touched that level in March 2020 and also in January 2016, but didn't last very long. And similarly, classic move. Didn't last long at all. Intraday actually is when that pullback was seen. We went back to then the sort of 143, 145 range that we had been in, dropped down below that after markets sort of got comfortable that we wouldn't see tariffs anytime soon. Then we've had this sort of multi-day rally in dollar CAD, so CAD weakening up to and beyond that 145 level again, but we just dropped now below that. Really interesting on the confirmation of the tariff news, but basically on possibilities that they won't be long lasting. So yeah, dollar CAD really is sort of bellwether for tariffs in general. We're still in this range, 143, 145, of course, but just to the lower point of it. Blue line's a 50-day moving average at 143.48. For us, really around sort of 143 is the low part of this range. And then you would get the 100-day moving average, which is the support level from that previous breakdown through 143. That level at 141.81, if we lose that, then could be interesting if we do see some relief from the tariffs just announced, which of course Lucknick mentioned overnight. Lots of volatility going on, of course, and lots to contend with. Just keep a track of news-wise, I guess, is key, and then just keeping positions very short, really, or very tight, and stops tight as well, unless you have a long-term view. But otherwise, yeah, it's very choppy out there, whippy price action, lots of opportunities, of course, but yeah, moving around with two-way price action. Exciting times, but yeah, very choppy as well. So we'll wrap it up there. We'll be back in a couple of weeks, but really do appreciate you guys tuning into the webinar, and we will speak to you very soon. Take care.